Well, thanks for coming along, Andy, and it's very good to have you here. I thought it'd be useful as a starting point if you could say something about Veritas's investment philosophy and how it fits into the wider Willis Towers Watson stable of managers.
Yeah, so we invest exclusively in high quality companies. So we have a very simple investment philosophy. All we're trying to do is find high quality companies. So that's those companies that we think have very strong barriers to entry. They're difficult to compete against. They're usually highly cash generative. And then we try and buy them when they're attractively valued. So we're looking for this combination of high quality and attractive valuation. And then we look to hold them for the very long term. So typically we hold a company for 5, 6, 7 years to benefit from that company's compounding of earnings and cash flows over the period. So it's a very simple investment philosophy. And in terms of looking at the other Willis Towers Watson managers within the stable, that they have a number of different types of managers in there. So they have high growth managers who are looking for companies that grow particularly fast, but again, over the long term. And then they have some more value orientated managers within the stable. And so we sort of fit in the middle of that, looking for these high quality but growing companies and trying to buy them when they are attractively valued.
So how did the portfolio perform both absolutely and relative to its benchmark index last year and also this year to date, 2022?
We're very focused on long-term absolute return, so typically we look out over 5 years. But in 2021, from an absolute perspective, we delivered around 16.5% annual return in 2021, which obviously is better than our expectation for a single year in terms of inflation plus, where we aim for around 6 to 10% plus inflation. On a relative basis, it's slightly underperformed an all-equity index like the MSCI World, which did around 19.5% in 2021. In the first quarter of 2022, markets actually declined substantially for the first couple of months, but then recovered a lot of that in March. And so I think the market was down around 2.7, 2.8%, and we performed a bit better than that. We were down about 2% so far to the end of March. During the big declines, we were actually a lot further ahead of the market. So in difficult markets where markets decline substantially, we tend to outperform a lot more.
And of course, you are anyway a very long-term investor, so these short-term timeframes are largely neither here nor there with your outlook.
That's correct. I mean, generally we look out over 5 years, so we try to analyse performance over a 5-year horizon.
Looking back over recent months, you have already alluded to this, but there has been a movement, a rotation out of growth-focused companies that thrive in a low interest rate environment and towards more value-focused businesses. So I was wondering, how does that affect, or how has it affected the portfolio's performance?
Yeah, so there's quite a lot going on under the surface of the equity market. So equity markets themselves haven't moved all that much year to date, but underneath the surface a lot has changed. So as you allude to there, high growth companies and those that are very sensitive to rates have fallen a long way. So particularly those high growth companies with no earnings but good revenue growth, we've seen some of those fall 60, 70, 80%. And at the same time, we've seen some value orientated companies doing particularly well. But it's difficult to know if all those value-oriented companies are doing well because of interest rates or because of other factors. So a good example would be the energy complex, where they've performed very well, but it's to do with the oil price rising and gas prices rising, partly due to the conflict in Ukraine. Equally, that's the same with supply chains. And so we're seeing metals and mining companies doing well because supply chains have been disrupted. And then there's other areas like banks that are obviously interest rate sensitive, where they have done well because of this expectation of changing rates. So value has done well, but it might not all be due to the fact that rates are rising. Within the portfolio, we have quite a good exposure to companies that are lowly valued or have high free cash flow yields. And these companies are doing well because they're generating cash today, and cash today in a rising rate environment is obviously very positive. So we have a number of those companies within the portfolio that are helping.
Could you give me an example?
We own a company in the US called CVS, which is a vertically integrated healthcare company that has a health insurance company within it, a purchasing benefits manager, which is a part of the company that buys drugs and uses scale to buy those drugs cheaply, and a retail pharmacy. So they own around 10,000 retail pharmacies in the US. And it's a very cheap company, so it has a very high free cash flow yield. It trades on around a 9% free cash flow yield or so. And in a rising rate environment, those companies that generate cash today obviously are beneficiaries of that environment relative to those companies that are high growth that we were talking about before. So it's done particularly well.
And what about the investment opportunities that this rotation has thrown up? I mean, what I'm thinking is perhaps you've been able to pick up digitally focused companies at relatively low valuations, for example.
Yeah, so the way our process works is we analyse around 200 to 250 companies at any one time. And we do a huge amount of work on those companies before we're allowed to invest in them. So we will typically do 8 to 10 weeks worth to start with on a potential company. And so those companies we already cover, and we're looking at them for opportunities. But at the moment, the prices haven't dropped sufficiently for us to be interested in buying them. We are at the same time accelerating some work on companies that have fallen a long way. So a company like PayPal, for example, I think PayPal has fallen 70% from its peak. And so we're beginning to look at those companies as well, but at the moment we haven't invested in any.
Are there any other themes you like beyond the digital one where you can see there may be attractive opportunities coming up?
So we analyse across a full gamut of areas, excluding perhaps energy, mining, banks, where we don't really have any opportunities for us to invest in because there are insufficient high quality companies. And we're not really seeing any specific area where there are more attractive opportunities. Certainly where the opportunities are beginning to arise is in those higher growth companies where they've sold off substantially. And so that is where we're doing more work. But at the moment, the valuations haven't come back to a point where we think they're attractive enough.
And you're anticipating that the valuations may have further to fall?
Yeah, I think if we continue to see interest rate rises, as the Federal Reserve has talked about, then those high growth companies are likely to fall further as bond yields begin to rise higher.
Veritas are longer term investors, as we've already discussed, and you're not very concerned about short term macroeconomic trends, but at the same time, the recent headlines have been full of concern about inflation and also about possible stagflation. So how do those pressures impact as far as the portfolio is concerned?
Yeah, so we think that the portfolio is reasonably well protected in the event of higher inflation. We tend to own companies that have very strong pricing power, and so in the event of inflation, they can price up and recoup that higher inflation. So a good example would be something like MasterCard that charges a small basis point fee on every transaction. But of course, as inflation impacts the value of those transactions, so the transaction value goes up, obviously the amount that they charge increases as the price of those things go up. Equally, we would invest in something or have invested in something called Vinci, which is a French toll road operator. So they own and operate toll roads, where the pricing mechanism for the charges on those toll roads goes up in line with inflation. So we try and find these companies that have very strong pricing power, and at the same time we tend to avoid companies that require huge and growing investments that would be subject to higher and higher prices as inflation rises. And so I think the portfolio is well protected in terms of inflation. In terms of the stagflation part, so the economic impact, if we see a slowdown in economic growth, we have quite a high exposure to non-economically related areas like healthcare. And so healthcare tends to grow regardless of the speed of economic growth. And so again, I think in the event of stagflation, the portfolio would be fairly well protected.
I guess following on from that, capital protection, capital preservation becomes a much bigger deal for investors in a more inflationary environment, and particularly if they fear that markets are going to be very volatile as well. How far is the portfolio protected against the risk of actual capital loss?
So we obviously, as we said before, we're absolute long-term investors, and so we do look to generate absolute returns for clients over a sensible time horizon, which we see as 3 to 5 year time horizons. And so what we're investing in are companies that have strong pricing power. We buy them when we think they're attractively valued, so they typically have high free cash flow yield, so they're generating cash today. And so in the event of inflation, we may see a quarter or two where markets decline and some of the portfolio companies that we hold will decline as well. We would generally expect that if we see that, so a substantial decline in markets, we would expect that the portfolio declines less than the markets because of the nature of the companies we hold. They're high quality, they have high barriers to entry, they're generally very cash generative, they generally have very strong balance sheets. And then over a longer term horizon, so again back to that 3 to 5 year horizon, we do anticipate that we can deliver absolute returns across the portfolio.
The other big issue at the moment, which is compounding uncertainty for everybody, of course, is the war in Ukraine. How is that affecting the portfolio and the decisions that you're making? I'm thinking about things like opportunities in defence spending or in rising fuel prices, for example.
So the first thing we did with the war in Ukraine was look at our Russian and Ukrainian exposure within the portfolio. And we have no direct Russian or Ukrainian exposure in terms of companies that are listed within Russia or Ukraine in the portfolio. But across the companies, we think we have around 70 basis points, so under 1% revenue exposure to Russia and Ukraine together. So we think it's not material within the context of the portfolio. And then in terms of opportunities or threats, we have a mixture within the portfolio. So most companies are not hugely affected. So take something like Google that we own within the portfolio, Alphabet. Obviously, it has some revenue from both Ukraine and from Russia, but it's quite a small amount. And so they are affected, but it's quite minimal. Whereas we own BAE in the portfolio, and BAE is obviously a defence company, and so that's had a big beneficial effect as people and the Ukraine require more and more armaments. And also, there's a knock-on effect as NATO countries look to increase their spending commitments to defence. But on the other side, we have some companies where they might require raw materials that come from either Russia or Ukraine. There's only one particular company that we have some concern over, which is Safran. Safran makes aerospace engines, so they make the engine, for example, the Boeing 737 or the Airbus A320. And around half of the titanium that they require for those engines comes from Russia. Now, we've spoken to the company. They have stockpiles of titanium that should last them for most of the rest of 2022. And they are actively trying to source more titanium from their other sources. And so at the moment, we feel they will be fine. They are still getting titanium from Russia at the moment. It's not on the contravened items list. So at the moment, they're fine, but it's something we're keeping a very close eye on.
One thing that has really lost the media's attention recently has been global warming. Not to say that it's gone away, obviously, it by no means has, but more pressing concerns like Ukraine and inflationary pressures have really distracted people, I guess. Are you concerned that that is going to set back ESG as an investment trend?
Not at all, actually. Whilst ESG has definitely come out of the eye of the media, it's still very much in the focus of most investors' eyes. And so I don't think that the momentum on ESG has dropped at all. And certainly the pressure that we put on companies, particularly on the carbon side, remains huge. So when we analyse companies, we obviously, during our process, we look at all of the ESG issues, and we will then address those with the company. So we'll go to each company and we'll address whatever the most pertinent issues are. And in some cases, we will refuse to invest if we think there are issues within the company that mean that we can't invest from an ESG perspective. Then we will drop the company, we will finish our analysis, and just we will not invest in those companies. So I don't think really that the ESG issues have dropped momentum at all.
And I mean, now it's coming up to reporting season. It started reporting season. Are you bringing pressure to bear in that respect at the moment?
Yeah, it's something we always do. So we tend to work behind the scenes and try and persuade management that it's in their best interests to follow best ESG, and particularly on carbon emissions. And so we have a pathway for all companies to follow, which goes from disclosure first through CDP or similar TCFD, all the way through to science-based targets reductions. And so we have this process that we like them to follow. And where they're dragging their feet, we are very happy to vote against the management teams. And so we will, first of all, engage with the management teams. But then if they drag their feet, we will vote against.
Are you finding companies are being more responsive these days?
In general, I think companies are more responsive. We do still have one or two where they drag their feet and we have to put a lot of pressure on them. But in general, I think the management teams do understand how urgent this issue is, and they generally have moved very fast.
What about ESG, the broader context, not just the carbon emissions, but the social and the governance aspects of the whole movement?
Yeah, again, that's an area that we put a lot of attention on, all aspects of E, S and G. A good example for us would be the defence area. So we've always felt that defence companies, particularly in the Western world, so NATO countries, we felt that the defence companies are actually a force for good, in that we require defence companies to protect ourselves against states such as Iran or North Korea, where if we didn't have a good defence and good defence capabilities, then those companies would hold the Western world and NATO companies to hostage. And so we've always felt that these companies are actually a force for good in terms of ESG. That hasn't really been the case more widely. I think they've always been seen as quite controversial. But I think actually, and interestingly, the war in Ukraine has highlighted how these companies, these defence companies, can actually be a force for good in terms of defending yourself, not being an aggressor or an attacker, but actually defending the nation. And I think people are coming around to the same view that we have, that these are actually a force for good in a world where we have the likes of North Korea and Iran.
And you do actually hold some defence companies?
That's right. So we analyse a number of defence companies, and we hold BAE in the UK, which is very well managed. We think that the management team at BAE are particularly good, and it's a very cheap company. Now, obviously, year to date, it's done particularly well, as people have looked at the company and realised that armament spending is going to increase, not just on the war in Ukraine, but more widely. NATO members are likely to dedicate more of their budgets to defence spending from here on. So the company has done well, but it remains a very cheap company in our opinion.
So finally, I wonder if you could tell me about a wildcard stock that you hold, by which I'm thinking of something that's a little bit left field or unconventional, maybe not so well known in this country, but that you think has got a lot of potential still.
We own a company in the US called Fiserv that not many people will have heard of. But Fiserv is embedded within the financial services industry in the US and basically sits behind many financial transactions. So they are the market leader in day-to-day account processing for US banks. So they sit behind most of the accounts within the US. They're also very strong in what's called merchant acquiring. So that's where they will authenticate and ensure that the payments go between a merchant and a cardholder. So when you make a purchase at a shop, they will be the ones that sit behind that transaction and ensure that the money gets paid to the right people. And if there's a refund, they will be responsible for doing that too. So we think they're very well placed. We also think that they will benefit from the shift from cash to card payments, which we're continuing to see and obviously was accelerated by COVID. They're also inflationary protected because as payments increase with inflation, obviously the amount that they receive increases with inflation too. But the share price hasn't been very strong. And the reason for that is that other investors are worried about new up-and-coming technology companies within the financial world called fintech companies that might take some market share from them. Now, we think that that's largely unlikely because Fiserv is so well embedded in the financial services industry that it's hard to see how they could be displaced. There's a particular competitor that investors are worried about called Square. Now, Square do what are called mobile point of sale systems, where if you go to a merchant that requires to take that payment mobile from in a mobile's perspective, they will have a reader that allows to take the payment. And it's grown very fast to Square. Now, Fiserv have their own equivalent called Clover. And Clover has grown extremely fast and is now larger than Square in terms of the amount of money that they process. And so we don't think that Square will be able to undermine a company like Fiserv, because Fiserv can respond and use their scale to respond, and their relationships with banks and with merchants. And so we think they're very well placed. We also think the company is very cheap. So it trades on a free cash flow yield, so that's its free cash flow divided by its share price, of around 6.5%. For 2021 and around 7.5% for 2022, which makes it look very cheap relative to most companies. And that free cash flow is growing very fast. So we see a mid-teens growth rate in free cash flow for the foreseeable future. So we think it's a very cheap company, very well placed, very strong barriers to entry, and we think it'll do well in the portfolio over the next few years.
And at the moment, it's based mainly in the US, is it? Or is it also a company that we might be using here in the UK?
It's largely based in the US, so its market share amongst banks is very high in the US for day-to-day account processing. But as it spreads through technology, for example, Clover, so Clover is widely spread throughout the UK, and also as the banks that use it within the US move more internationally, they tend to move with the software providers and the technology providers that they're happy with, and so Fiserv benefits from that too. So it's becoming more international, but at the moment it is largely a US company.
So interesting potential for further growth for the company then?
Absolutely. As its customers internationalise, so will Fiserv.
Thank you so much, Andy. It's been a pleasure to talk to you.
It's a pleasure, Faith.